If you're in your 20s or 30s, you're playing a financial game with hidden rules. You are told to hustle into the top 1%, but the strategies most use guarantee they go broke. Open your phone and you are immediately pressured to make a choice. You can either finance a lifestyle you can't afford with credit cards and personal loans, or you can risk all your savings on fast money day trading. The standard advice is to opt out of the madness and keep your cash safe in a traditional bank account. But sitting on cash allows hidden economic forces to quietly eradicate your purchasing power. To survive and build real wealth, you must master exactly two frameworks: the math of real inflation and the psychology of restraint. Choosing a boring, mathematically grounded reality over the flashy social media illusion is the only proven way to avoid the middle-class poverty trap and buy back your time. Governments report an official inflation rate hovering around 4 to 6%. That baseline is fine for measuring the price of basic groceries, but it entirely misses the reality of your biggest expenses. This chart compares the official baseline against the actual costs of middle-class survival. By mapping education, healthcare, and housing, real inflation tracks closer to 10%. Meanwhile, a standard fixed deposit 7% return drops to 5% after taxes. That negative gap between your 5% post-tax return and real-world 10% inflation means keeping cash safe in a bank mathematically guarantees your purchasing power shrinks by 3 to 5% every single year. When you view the numbers this way, accepting the volatility of the stock market stops feeling like a risky choice. It becomes a mathematical necessity to prevent the guaranteed bleeding of your wealth. The practical way to handle that market volatility without risking your daily survival is to allocate your money strictly by when you need it. We separate capital into 3 buckets. Bucket 1 is liquid cash for the next 12 months. Bucket 2 holds money for big expenses in 1 to 5 years, parked in debt funds. Bucket 3 is locked-in index funds over a decade for high returns. The strict rule of Bucket 3 is that you absolutely never touch this capital for at least a decade. You must willingly endure short-term market crashes without selling. This structure works because it removes human emotion from your financial planning. You aren't trying to time the market. You are using time itself to turn your money into a tireless employee. But the math won't save you if your behavior is self-destructive. As your income rises in your 20s, the societal pressure to match your peers by financing depreciating assets, like luxury cars or lavish weddings, skyrockets. We judge wealth by what we see. But true wealth is invisible. It is the financial assets that haven't yet been converted into tangible stuff you can show off. Most people only save when they have a specific purchase in mind. Saving money without a specific goal is the only way to create a permanent, protective gap between your ego and your income. The most successful investors in history built their fortunes not through flashy spending or rapid trading, but through extreme patience and endurance. By sacrificing short-term social applause and the appearance of wealth, you purchase the ultimate defense mechanism, the flexibility to survive disasters and seize unexpected opportunities when everyone else is financially tapped out. The absolute enemy of that patience is the temptation of fast money and dopamine through futures and options day trading. Social media FOMO convinces young earners they can accelerate to the top 1% by simply outsmarting the market on their phones. The reality is, active day trading is a rigged game. You are competing against massive institutional forces, which usually ends in total capital wipeout. This quadrant chart visualizes the trade-off. Futures and options trading land squarely in the high-effort, high-stress, low-probability zone. By contrast, boring index fund SIPs sit safely in the low-effort, high-probability corner. Attempting to cheat the slow, proven math of compounding by taking on high-risk active trades is the fastest way to guarantee a permanent loss of both your money and your time. Your financial journey comes down to a strict choice between 2 mutually exclusive games. This scorecard compares the ego game against the freedom game. The ego game is for those whose absolute priority is social validation. To play it, you must be willing to work high-stress jobs indefinitely, simply to service the debt required to look rich. The freedom game is for those willing to ignore peer judgment completely. You have to endure the boredom of long-term compounding and prioritize invisible wealth over visible status. The highest dividend money can pay you is not a luxury car or a massive house. It is total, unyielding control over your own time. Right now, your money is either accruing interest against you via consumer loans, or it is quietly compounding for you in the market. You have to choose who your money works for.